If you strip away every chart, every strategy, every flashy setup, trading is nothing more than a mirror. A mirror that reflects discipline or chaos, patience or impulse, truth or illusion. After 15 years in the market, I've learned that success doesn't come from mastering indicators. It comes from mastering yourself. But here's the uncomfortable truth. The gap between a successful trader and a failing one isn't about luck or even intelligence. It's structural. It's built into how each person perceives uncertainty, reacts to pain, and adapts to information. Every day, two traders enter the same market. They look at the same chart. They might even take the same trade. Yet one walks away compounding wealth, the other compounding regret. Why? What invisible mechanics decide their fate? That's what this video will unpack. Because these differences aren't surface-level habits, they're fundamental operating systems, hidden psychological and strategic frameworks that silently dictate results. We'll break down 5 core differences, not motivational slogans, but structural realities that define who survives and who doesn't. You'll see how successful traders interpret volatility like language, while failing traders misread it as chaos. You'll understand why some treat losses as data, while others treat them as personal defeat. This isn't about mindset cliches. It's about decoding how the game truly works, from liquidity cycles to behavioral asymmetry, and understanding why 90% lose not because they lack skill, but because they play the wrong game entirely. By the end, you won't just feel inspired. You'll see differently. You'll think like the sharks who move silently beneath the surface, patient, strategic, and unfazed by the noise above. Now, let's step into that mirror. And let's dissect the anatomy of trading success, one layer at a time. When I first entered the market, I thought success came from knowing more indicators, more books, more strategies. But over time, I realized the market doesn't reward knowledge. It rewards clarity. That clarity is what separates the two kinds of traders. Successful traders build structure around uncertainty. Failing traders build emotion around it. It starts with how they interpret randomness. The losing trader sees randomness as threat. Every losing streak feels like an attack. Every red candle feels personal. So they fight it. They overtrade to get back. They change systems after 2 losses. Their equity curve becomes a mirror of their emotions, unstable, reactive, fragmented. The successful trader, they see randomness as data density. Every move, win or loss, is information about structure, liquidity, and crowd psychology. They don't need every trade to win, they just need every trade to teach. This is the first structural divide. One reacts to uncertainty, the other integrates it. The losing trader treats the market as an adversary, something to conquer. The winning trader treats it as a partner in feedback. They don't fight it, they learn its rhythm. Over time, this creates an asymmetry. One compounds emotional instability, the other compounds informational insight. Another layer of the divide is time perception. Failing traders live in the short term. They think in trades. Successful traders live in cycles. They think in systems. One's goal is to be right. The other's goal is to stay in the game. This shift in perception changes everything. When your time horizon expands, volatility stops being noise. It becomes a pattern generator. You stop chasing setups, you start recognizing structure. And here's the paradox. Both traders can have identical technical skills, even identical entries, but their internal feedback loops rewrite the outcome. Because in markets, behavior compounds faster than capital. That's why the gap between successful and failing traders keeps widening even when they start from the same place. It's not about better strategies, it's about better structure. The losing trader upgrades tools. The winning trader upgrades mental architecture.
Most traders believe that having more information gives them an edge. But in markets, information is never the problem. Interpretation is. Every second, the market transmits terabytes of price data, volume fluctuations, liquidity imbalances, and sentiment shifts. All traders see the same thing, but they process it differently. That difference defines everything. Unsuccessful traders chase information the way gamblers chase odds. They scroll through news feeds, Discord chats, and social media, trying to make sense of the noise. Their minds become a battlefield of contradictory narratives. Inflation data, Fed minutes, CPI surprises, all mashed together with no hierarchy of relevance. The brain, overloaded, starts connecting dots that don't exist. A professional trader processes data through a filter of context. They don't ask what happened, they ask what matters. Let's take a simple example. If Bitcoin breaks below a key level, a retail trader panics. It looks like collapse. But a professional immediately asks, is liquidity being engineered below that level? Who's trapped, retail longs or institutional shorts? What phase of the market structure are we in? To them, price isn't just movement, it's intent. They read the market not as numbers, but as behavior. This is why successful traders build information hierarchies. At the top are core market dynamics, liquidity, volatility cycles, and order flow behavior. At the bottom are surface distractions, news headlines, influencer calls, and chart noise. The ability to rank information by structural importance turns chaos into clarity. There's also a neurological dimension. Losing traders often operate in a reactive state, high cortisol, low focus. Every red candle spikes emotion. The brain switches from analysis to survival mode. In that state, the prefrontal cortex, the part responsible for rational evaluation, literally shuts down. You're not trading, you're defending. Experienced traders train the opposite muscle, response control. They design mental frameworks that slow cognition down under stress. Breathing patterns, pre-trade checklists, bias resets. This isn't discipline talk, it's neuro-performance engineering. Here's the hidden truth. The market doesn't reward intelligence, it rewards adaptive cognition. The ability to absorb complexity, simplify it, and act decisively without emotional noise. That's why top traders spend more time deleting data than collecting it. They narrow focus to just a few high-impact metrics: market structure, liquidity behavior, volatility compression. The fewer variables they process, the sharper their pattern recognition becomes. Meanwhile, the average trader constantly rewires their belief system. Monday, trend following. Tuesday, mean reversion. Wednesday, sentiment model. By Friday, nothing makes sense because they've confused exposure with understanding. True professionals have a stable interpretive lens. It's not fixed, but it's consistent. They can adjust to regime changes, but always within a coherent mental framework. So when you see a pro entering a trade that looks like obvious, it's not luck or instinct. It's refined cognition, a synthesis of context, probability, and execution timing. The key takeaway is this: the edge isn't in finding more data, it's in filtering faster, cleaner, and deeper. That's the cognitive separation between traders who survive and those who self-destruct.
For most traders, risk is synonymous with loss. But for professionals, risk isn't something to be feared. It's something to be priced, managed, and utilized. This mental shift sounds subtle, yet it defines who stays in the game and who gets eliminated. The average trader's relationship with risk is emotional. They feel risk as anxiety, a tightening chest, a racing pulse. Each tick against them feels personal. Their goal is to avoid pain, not manage probability. This leads to inconsistent behavior, cutting winners short to protect profit or holding losers too long to avoid being wrong. Professionals see risk as a quantitative reality, not an emotional event. They understand that markets are probabilistic systems, not moral ones. There's no right or wrong, only expected value. Every trade for them is a bet on distribution. The question isn't, will this work? It's, does this setup pay me more when it works than it costs when it fails? This framing changes everything. A professional will gladly take a 40% win rate strategy if the payoff ratio is 3-to-1. A retail trader will abandon that same system after 3 losses in a row. Why? Because the retail trader feels each trade individually. The professional thinks in series, a long sequence of data points converging toward statistical edge. This is what I call probabilistic detachment, the ability to emotionally disconnect from individual outcomes while staying intellectually engaged with the system. There's another layer, perception of danger. Amateurs define danger as volatility. The market is too wild. Professionals define danger as uncertainty they can't price. Volatility doesn't scare them, opacity does. That's why pros are comfortable trading high-volatility assets like crude oil or NASDAQ futures, not because they enjoy risk, but because they understand it. They know where liquidity pools sit, how spreads behave, and what structural conditions drive extreme moves. For them, volatility equals opportunity density. For the untrained trader, it equals chaos. Then comes the paradox. Professionals are actually more conservative than retail traders, not less. They risk smaller percentages per trade, maintain asymmetric reward structures, and respect the compounding nature of drawdown. An amateur will risk 10% on a trade to recover faster. A professional risks 1% because they understand recovery math. Lose 10%, you need plus 11% to get even. Lose 50%, you need plus 100%. Lose everything, game over. They don't chase recovery, they protect continuity. This is the second layer of professional risk perception, survival bias awareness. They know most market participants never survive long enough to realize their potential. Therefore, capital preservation isn't defensive, it's offensive. Staying solvent means staying eligible for opportunity. And finally, true professionals embrace risk as information. Each losing trade refines their probability curve. It's not punishment, it's feedback. Losses reveal variance. Variance reveals edge. They don't try to eliminate uncertainty, they try to model it. So while beginners are trapped in emotional cycles, fear to overcompensation, to loss, to desperation, professionals loop through a rational cycle, hypothesis to test, to feedback, to adjustment. In essence, they trade reality, not emotion. The retail trader fears risk, the professional studies it, and the market rewards the one who treats risk as data, not danger.
If risk perception defines how a trader survives, time perception defines why they succeed. The difference between a struggling trader and a consistent one often has less to do with strategy and everything to do with time orientation. Most retail traders live inside short time frames, not just on their charts, but in their minds. They measure success by the next trade, the next day, or the next week. They chase immediacy, fast profit, quick validation, instant confirmation. Professionals, on the other hand, think in cycles. Their reference frame is not the trade, but the process, not the tick, but the trajectory. They understand that the market is a living system of rhythms and feedback loops. Each cycle, accumulation, manipulation, expansion, distribution, takes time to develop, time to reveal its structure, and time to pay off.
The retail trader tries to force the market to move within his emotional window. The professional waits for the market to align with his probabilistic window. That's why patience is not a passive skill, it's a weapon. A retail trader sees inactivity as boredom. A professional sees it as control. Waiting isn't about doing nothing, it's about preserving mental and financial energy for when the odds converge. There's also a deeper dimension to this: temporal awareness. Most amateurs underestimate how much time the market needs to digest information. They expect cause and effect to be linear. A news release should move price now. A pattern should complete today. But markets are non-linear systems. They absorb liquidity, rebalance positions, and build consensus before breaking structure. Professionals think in time distributions, not deadlines. They don't demand that the market respect their schedule. They align with the market's natural tempo, the heartbeat of institutional activity. And this alignment extends beyond charts. Successful traders design their entire career around long-term compounding. They know that consistency doesn't come from daily wins. It comes from statistical reinforcement across thousands of data points over years. This is where most traders fail. They're addicted to speed. They believe faster execution equals faster growth. But in markets, time distortion kills awareness. When you shorten your horizon, you amplify randomness. When you extend it, you clarify structure. That's why experienced traders zoom out, not to find bigger moves, but to reduce noise. They understand that clarity scales inversely with time compression. In other words, the longer your perspective, the sharper your understanding. Another distinction: professionals respect compound time. They know returns compound, but so does discipline, patience, and reputation. Each day they manage risk correctly, they're compounding emotional stability. Each week they review data, they're compounding pattern recognition. Each month they trade within rules, they're compounding resilience. And eventually, this time compounding becomes their edge. Amateurs want exponential growth in equity. Professionals achieve exponential growth in process fidelity. The paradox is that when you stop rushing profits, they start to accelerate. Because you're no longer fighting time, you're synchronized with it. The retail trader trades the moment. The professional trades the timeline. The difference is not in the chart they look at, but in the time frame they live in. And in markets where every second invites noise, temporal clarity becomes the rarest and most powerful form of edge.
In the modern market, information is both the most valuable resource and the most dangerous toxin. Every trader swims in an ocean of signals, data, opinions, and narratives. Yet very few learn to distinguish information from interference. Retail traders, almost by instinct, seek more input. They believe clarity comes from accumulation, more indicators, more confirmations, more sources, more screens. But in reality, clarity comes from reduction. Professionals understand that markets don't reward those who know the most. They reward those who can extract the most relevant piece of data from the chaos. This is what I call the filtration edge. A professional trader doesn't process information linearly. They process it hierarchically. They assign context before interpretation. For example, when a retail trader reads a headline, "Inflation higher than expected," they instantly react. "This is bearish for stocks. I should sell." But a professional pauses. They ask, how does this fit into the broader liquidity narrative?
Has the market already priced this in? What does this mean relative to rate expectations, not just price movement? In that pause lies the edge. The retail trader reacts. The professional reframes. Professionals build mental models, frameworks that help them sort noise from signal. Instead of reacting to what happens, they ask why it happens and for whom it happens. They understand that markets are constructed on the intentions of large players, institutions, algorithms, funds whose goals differ from retail sentiment. A professional doesn't just watch candles, they decode behavioral signatures. A sudden spike isn't volatility, it's information about liquidity imbalance. A false breakout isn't random, it's an engineered liquidity grab. Retail traders chase movement. Professionals chase meaning. This is why most amateurs drown in content. They mistake information for insight. They binge-watch analysts, check social media, and chase predictions, thinking more data equals more control. But more data without structure only amplifies bias. Professionals, on the other hand, design information diets. They consume less, but process deeper. They read the same chart for hours until they understand contextual asymmetry. They journal trades, test hypotheses, and let the market confirm or reject their models, not their emotions. This filtration process is not passive. It's a continuous loop. Observe, hypothesize, validate, refine. Over time, it evolves into intuition, not the mystical kind, but the statistical one that comes from repeated, structured exposure to truth. Amateurs often mistake that intuition for luck, but it's simply data mastery, an accumulation of verified observations filtered through discipline. Here's a fundamental truth. The market is not hiding information. It's burying it under noise. The job of a professional trader is not to find more data, but to excavate the right layer of reality beneath psychological and narrative sediment. And this ability to filter is what separates conviction from confusion. While retail traders feel the need to act on every piece of news, professionals act on probabilities confirmed by structure. Because in the long run, it's not information overload that kills traders. It's information mismanagement. The successful trader is not the one who sees the most, but the one who knows what to ignore. That's the paradox of knowledge in the market. Wisdom begins when you start deleting data.
The deepest difference between a successful trader and a failing one is not in strategy, not in risk management, and not even in discipline. It's in identity. Most retail traders play the role of a trader. They adopt the surface traits, multiple monitors, trading jargon, market opinions, social media presence. But beneath that, they still identify as spectators, people trying to win at the market rather than belonging to it. Professionals don't play a trader, they become one. Trading isn't a hobby, it's a way of being. Their entire decision-making system, emotional framework, and lifestyle orbit around the market's rhythm. A professional doesn't ask, will this trade win? They ask, is this trade consistent with who I am as a trader? That subtle shift changes everything. When you play a role, you chase outcomes to validate that role. When you embody an identity, you perform actions that reinforce it, regardless of the outcome. Professionals build their identity around process integrity, not performance spikes. Every win or loss is data, not validation. They don't celebrate profits, they celebrate alignment. They don't fear drawdowns, they analyze deviation. They don't seek adrenaline, they seek symmetry between their behavior and their framework. This is why professional traders appear calm, even during extreme volatility. They are not suppressing emotion,
They've simply detached their self-worth from their trade results. Retail traders say, "I lost." Professionals say, "The system underperformed." That linguistic difference is the psychological firewall that keeps them sane. An amateur trader constantly shifts identity. Scalper one week, swing trader the next, macro analyst the following month. They shape their identity around temporary results. A professional chooses one core identity archetype: the observer, the strategist, the executioner, and develops depth within it. For example, a professional price action trader doesn't need indicators because his identity is rooted in reading raw behavior. His confidence doesn't come from confirmation, it comes from repetition. Identity gives structure to intuition. And when your identity stabilizes, your trading finally has emotional continuity. You stop overtrading to prove yourself. You stop revenge trading after loss. You stop seeking external validation because your framework already defines your boundaries. This is why mindset training, affirmations, and discipline hacks rarely work for retail traders. They're trying to modify behavior while their identity remains fragile. It's like repainting a wall when the foundation is cracked. Real transformation happens only when you stop trying to act like a trader and start becoming one. Professionals understand this paradox. Consistency is not something you do, it's something you are. That's why the journey of trading mastery is ultimately a journey of identity engineering. Each layer, from knowledge to conviction to calmness, is a reflection of who you've become, not what you've memorized. To trade professionally is to live professionally. Your sleep, your thoughts, your information intake, your emotional hygiene all become extensions of your trading architecture. And that's the final, often invisible edge. While retail traders try to find the Holy Grail strategy, professionals realize they themselves are the system. The market doesn't pay you for your trades. It pays you for who you've become in order to make them. By now, we've dissected 5 dimensions of contrast, from how traders process information to how they build identity. But the real insight emerges when you integrate them. Because in trading, these differences are not isolated traits, they form a living system. A professional trader's success is not linear, it's architectural. Each layer supports and reinforces the next, creating structural integrity. Let's trace how this architecture unfolds. It starts with information processing, the ability to filter signal from noise. This is the trader's sensory system. Retail traders overload themselves with contradictory data, chasing confirmation. Professionals do the opposite. They curate input flow until it becomes minimal but meaningful. This discipline of input control creates mental silence, the foundation for clear execution. From that clarity grows emotional regulation, the second pillar. When information is stable, emotion stops being chaotic. Professionals don't suppress emotions, they structure them. Fear, greed, hesitation all become measurable components of feedback. They treat emotion like volatility, something to model, not to fear. That emotional structure feeds directly into risk architecture. Here, every decision has a cost function. Losing traders see risk as something to avoid. Professionals see it as a currency they pay for opportunity. They budget risk the way engineers budget energy, with precision and foresight. It's not about avoiding drawdown. It's about surviving long enough to exploit asymmetry. Then comes execution discipline, the kinetic layer. Professionals don't trade when they feel ready. They trade when the structure aligns. Each move is a system output, not an emotional impulse. They don't measure success by P&L, but by process fidelity. This transforms trading from gambling to engineering. And all of it, information, emotion, risk, execution, is anchored in identity, the trader's internal operating system. Without a stable identity, the previous layers collapse under pressure, because markets test not your system, but your sense of self within it. A fragile identity amplifies fear and inconsistency. A solid one absorbs uncertainty like a shock absorber. When these 5 elements interlock, they form what I call the professional trader feedback loop. Information, emotion, risk, execution, identity, back to information. Each cycle reinforces clarity, calmness, and control. This loop is what gives professionals their edge. Not IQ, not technology, but structural alignment. Meanwhile, retail traders operate in a broken loop. Noise, emotion, impulse, loss, self-doubt, more noise. They get trapped in a spiral that feeds on confusion and self-sabotage. The professional's loop compounds stability over time. The amateur's loop compounds volatility. That's why 2 traders can trade the same setup and get opposite outcomes. One is aligned internally, the other is fragmented. This is the secret symmetry of trading mastery. Success is not additive, it's recursive. You don't stack skills, you integrate systems. The more your internal architecture mirrors the structure of the market, cyclical, adaptive, self-correcting, the more natural trading becomes. That's when you stop trying to win and start flowing with the market. Each trade becomes a small act of alignment. Each result, a feedback signal for refinement. The market stops being chaos. It becomes a mirror. And when you've built yourself into a structure capable of reflection without distortion, that's when you truly evolve from trader to operator.
There is a persistent illusion in trading circles. The belief that intelligence determines success. That somehow the sharpest minds, the best analysts, or the fastest coders are the ones destined to win. But the market doesn't pay for intelligence. It pays for adaptation. I've met traders with Ivy League degrees, fluent in mathematics and macroeconomics, yet they couldn't survive 6 months in live trading. I've also met construction workers, ex-soldiers, and musicians who quietly compound their accounts with surgical precision. The difference? Not IQ, emotional calibration. Markets are adversarial by nature. They don't reward cleverness. They punish rigidity. The smarter you think you are, the more dangerous your conviction becomes, because intelligence tends to defend itself. It rationalizes losses, doubles down on bias, and resists uncertainty. That's why the market humbles intellect faster than any other domain. What truly matters is meta-intelligence, the ability to adapt your own cognition in real time. Professional traders don't cling to being right. They optimize for staying solvent. They understand that in the long run, survival is intelligence. This is why so many high IQ traders fail, because they confuse analysis with awareness. They can build perfect models, but they can't model themselves. Their charts are precise, but their behavior is chaotic. The market doesn't care how elegant your logic is if your emotional system can't execute it. It doesn't care how well you understand macro data if you can't hold conviction through a 5% drawdown. It doesn't care how much you read if you can't manage your impulses. Success in trading comes from cognitive flexibility, from the ability to switch frames without emotional drag, from updating beliefs as easily as price updates a chart, from staying objective under pressure, not because you're a robot, but because you've trained your nervous system to respond with neutrality. Professional traders build systems around this adaptability. They don't forecast, they flowcast. They don't seek certainty,
They seek resilience. They don't try to outthink the market, they try to outlast everyone else. This is why humility is the highest form of intelligence in trading. Humility keeps you learning. It keeps your ego from anchoring your strategy. It allows you to pivot when the market shifts without needing to be right. Every professional I know has gone through this metamorphosis, from believing they could outsmart the market, to realizing they must outgrow themselves, to finally understanding that mastery is not dominance, it's synchronization. Retail traders chase intellectual validation. They want to feel smart. Professionals chase evolutionary validation. They want to become adaptive. The irony is that the most successful traders often sound simple, even boring, because simplicity is the residue of sophistication. After years of complexity, they arrive at clarity. Their charts look empty, their words minimal, their process repetitive, but that's the mark of true intelligence in trading: elegant reduction. Trading doesn't reward the one who knows the most. It rewards the one who learns the fastest. And in a game that constantly rewrites its own rules, that's the only edge that endures.
If strip away the charts, the news, the algorithms, and the noise, what remains is a very human equation. Trading, at its core, is not about markets. It's about the human operating within them. Every trade is a mirror. It reflects your discipline, your patience, your fear, your greed, and your capacity to hold uncertainty. The market simply amplifies what already exists inside you. That's why two traders can look at the same chart, the same signal, and the same entry, yet one finds freedom while the other finds chaos. The invisible equation behind every successful trader can be reduced to this: self-awareness multiplied by adaptation divided by ego equals longevity. That's the real math of the markets. Self-awareness lets you see your own tendencies. When you're impulsive, when you're afraid, when you're rationalizing. Adaptation lets you update your behavior faster than the market punishes your mistakes. And ego is the friction that distorts both. The less of it you have, the purer your decisions become. I've learned this equation the hard way. There were years I tried to beat the market with knowledge, until I realized knowledge was just another form of control. There were months I blamed volatility, brokers, or news events, until I saw that my biggest enemy was internal lag. Every breakthrough I've had came not from discovering new indicators, but from subtracting illusions. Trading is an elimination game. You don't win by adding more, you win by removing what doesn't serve your edge. You remove noise. You remove emotional overreaction. You remove the addiction to being right. And what remains is clarity. That razor-thin moment where decision and execution become one seamless motion. That's where mastery begins. All the traders who survive a decade or more share one defining trait: internal consistency. They may trade different systems, quant, discretionary, macro, or price action, but their internal environment is stable. They don't oscillate between fear and euphoria. They don't reinvent themselves after every loss. They simply keep refining, inch by inch, trade by trade. And it's in this quiet refinement that greatness is built. Not in the drama of big wins or losses, but in the repetition of small, precise actions. Because trading mastery is not an event. It's an ongoing recalibration of your perception, until the market no longer feels like an opponent, but an ecosystem you belong to. The truth is, every trader starts as a speculator, chasing moves, reacting to price. Then, if they survive long enough,
they evolve into observers, watching, waiting, understanding. And finally, a few transcend that stage to become architects. Those who no longer react to the market, but design systems that harmonize with it. That's the final transformation. When trading stops being a struggle against randomness and becomes a dialogue with probability. When your edge isn't something you find, but something you become. After 15 years, if I had to compress everything I've learned into one sentence, it would be this. The market is not a test of intelligence. It's a test of identity. Because once you understand who you are, what you fear, and what you value, the market stops being chaos. It becomes a mirror that reflects exactly how close you are to mastering yourself. And that's the invisible equation of trading success. The market rewards those who can face their own reflection and keep trading through it.